Well, hello traders, this is a amplified explanation of how I use the bond interest rates and yield overlays for my Forex trading. Incidentally, I just want to go real quick. For those who don't know, before I became a Forex trader, I was an avid treasury bond trader and S&P 500 day trader. And that was really the beginning of me finding this method, this concept. It wasn't taught to me. Um, I didn't read it in a book, so I'm sure um, most of you haven't seen this before, and I've seen several emails come to me suggesting the same thing, that they haven't seen this before. I assure you this has not been in any book, and I've got over, I'd say, about 2,300 books, um, either in electronic form or in a hard edition. And I can tell you from going through all the ones that most people have read, it's either not shared by other people and they know how to do it, which I'm not going to say it's not possible. I'm certain that it could be possible, but I can tell you no one else is sharing it. So to me, my belief is that these methods are very generic. In other words, they can't stop working. In other words, this is how the markets are engineered. It's based on someone having more money than all of us collectively and doing a lot more trading than all of us collectively. So I refer to that group of individuals as the smart money, and they are motivated the same way we are. You know, whether we want to admit it or not, greed is a factor in why we're doing what we're doing. We want to have more than we have. Otherwise, why are we doing it? If it's a hobby, then you're going to be probably short-lived in your career as a trader. Um, but since they are a greedy individual, collectively, they are in this to make money, and most of the time at our expense. They they will be doing a lot of buying and selling. And when they do those types of things, they're like an elephant, trampling through the snow. You cannot miss their tracks. They're right there. But if you are clear in knowing what you're supposed to be looking for, um, you can't miss the elephant. Put it that way. So let's look at how we can go into looking at these yield overlays. Okay, personally, I subscribe to eSignal. I don't suggest new traders subscribe to eSignal because it could be an expensive venue for someone just starting out. Um, I watch a lot of markets. I don't just focus on Forex. I look at the currency markets in not only the spot markets but also in the futures markets. And I also look at the stock market major averages, not just our U.S. averages. I look at all the other um, major countries' stock indexes, and I will look at how the Forex market ties in with all these things in conjunction with the interest rates. I don't care whether you're a stock trader, a futures trader, commodities, whether you're trading cocoa, live hogs, um, pork bellies, gold, silver, palladium, platinum. It doesn't matter to me. Oil, all of these markets and stocks and currencies mainly are influenced greatly by interest rates. Interest rates make the whole world go round, and the impact that the interest rate markets have on the derivatives markets and the tradable vehicles that we can put our money into and hopefully speculate and make a gain is great. It's a huge impact, and if you understand what interest rates are going to do and what that translates into in terms of the general market, you can really have your macro view or perspective in line with what the smart money is going to be making sure the market does. Um, it's 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 imperative that a trader focuses on the general tide of the market, whether it be stocks. You want to be trading in the direction that the general market averages are moving. So if the Dow Jones, Nasdaq, and S&P are moving up, it goes without saying that you should be looking to be a buyer of stocks. It makes it very difficult for individuals to short stocks when the market is generally going up, and vice versa. If the stock markets are going down, it's very difficult for traders that don't know what they're doing to buy a stock and see it appreciate in value as the general markets are trading lower. It'll be more or less a sympathy play, and most likely their stock of choice will be a laggard, and it won't see much upside. Now there are stocks that beat that trend and they are outstanding buying opportunities when the market changes from general market down to up. So that's something I could teach at a later time. But for a commodity trader and forex trader, we could use the CRB index. Okay, get the general market trend. Okay, are these markets poised to move higher or lower? And then by looking at that, as our top-down analysis begins, okay, that puts a lot of things in perspective. It keeps a lot of false signals and erroneous entries based on our directional premise being wrong, because if we haven't consulted this long-term perspective, we could be more or less shooting in the dark. It doesn't mean you won't get lucky once in a while catching a bounce in a bear market, but for the most part, you really want to be trading with the trend of the general market tide. With all that said, once you have that understood and you know what the market averages are doing, okay, right now you can position yourself for the next change in that general market trend. And the way you do that is you look at the interest rate markets. Now you're probably asking yourself, okay, this sounds great and I've seen your examples, but I want to know where to get this information myself. So I've got a lot of emails about this, guys, and for the last day I probably got about 72 emails with this very question in mind. Where can we get this information at? So it's free of charge on a numerous amount of websites that have any tie to the financial markets. The yields are pretty standard real estate in terms of data. Whether the website you like to go to or are familiar with, whether they do charting on it, I don't know, because so many. It's a vast choice to choose from. But I just put two websites that I have worked with: StockCharts.com and Bloomberg.com. This is in no way of a solicitation for you to go to them for anything that they may sell. I'm just suggesting that if you want to look at the bond overlays, this is a way of going without being charged any kind of money, so you can gauge whether it's effective or not. Again, I'm stressing that it's an end-of-day basis. You cannot rely on any intraday, or I'm assuming you can't pull up intraday basis data on the yields, but they are accessible through eSignal. And I believe I've done it in the past, but I didn't put it on this presentation here. But I believe LiveCharts, LiveCharts.com. I'm not even sure if that's even the website anymore, but I used to pull it up when I was a bond trader there as a backup in case eSignal went down. I'd have a real quick place to go to get my bond yields. Okay, so let's look at how we can do this on an overlay basis. Okay, folks, we've loaded up StockCharts.com. And once you get to their home page, what you're going to do is you're going to go up to Free Charts, click on that. You're going to go down to this Perf Charts. Okay, you want to scroll down just a little bit. And then where it says Create a Perf Chart, you want to type in the $TNX. Enter that, and what that does is pull up the 10-year T-note rate. And down here, at this little field here, what you're going to do is you're going to put a comma as a separator, put a $, type in US. And what that'll do is it'll pull up, you can get the dollar index by doing that, okay, but most importantly it'll give you the format how you want to type in to get your yields. Okay, so you want to put in the UST1Y if you want the 1-year treasury yield. I don't use that so much, but we're going to use that format to type in our yields. So it's $UST2Y. Okay, separate that with a comma. Okay, we'll put another $sign in there. And UST5Y, that'll be the 5-year yield, separated by a comma. Put another $sign in. Put in UST10Y. I know you're probably saying, isn't that already loaded? Yes, but I'm just doing it for the sake of having everything uniform. And let's put in the $UST30Y just for the 30-year bond rate to be included. And voila, there we have the overlays. Now you can scroll back and see how these diverged at key turning points in the market and go back over your charts and see if it didn't call the major tide change in the general market trend. In other words, when the interest rates were dropping, okay, the dollar followed. Now that we've turned up, you see this purple one? Okay, between the months of the last part of September of this year and the beginning of November, look at how the lows were not matched versus the low September, the low to November. Okay, we saw two of these yields go lower, but the two uppermost yields bucked that trend and they were not willing to go lower. Okay, so that caused the major market trend to change. Also notice that we had some lows here that were not met here, were not met here, and were not met here, and that gave us a pretty extrapolated move to the upside. And if you look at your forex charts, you'll see that that's exactly when the currencies had a major reaction point and it moved precipitously. So that's the stockcharts.com. Now let's take a look at Bloomberg real quick. Okay, folks, we are looking at Bloomberg.com. When you get to their website here, you want to go to market data. Okay. And you can see that there are bond rates and yields down here. Okay, and this is where you can get a real quick snapshot view of what you want to look at in terms of interest rates on the other markets. For instance, the Japanese, the UK, Australian. Now to pull up the bond yield overlays, you want to pull up you want to type in USGG number 2 YR colon IND and hit enter. And that'll give you your 2-year rate. Okay, and let's go to an interactive chart. Get rid of the volume, and we're going to add a comparison. Okay, and all we're going to do is repeat that USGG, put a 5 YR colon IND separated by a comma, then type in USGG 10 YR colon IND, hit enter, and there's your bond overlays for the 2-year, 5-year, and 10-year. You can see the same divergences here. Okay, and you can change the view from 6 months to 1 year, 3 months, and 1 week, 1 day, and once it gets down to like 1 day, your 2 years is going to get really, really spotty. And which brings me to, if you do go to an eSignal data feed, once you build your accounts up and you start feeling more comfortable spending money on the data feed, you want to consider maybe using the 5-year, the 10-year, and 30-year on an intraday basis on a line chart and overlay that, and you can actually get the real-time intraday failure swings that'll call the daily high and low on dollar and all the other foreign currencies. Also, you can use that to time your, if you are a bond trader still and you're in the commodities, these failure swings will time the bond market also, so you can buy that. And also, it will confirm rather the stock market movements in the daytime. But that's a whole different subject for another day. But I just wanted to give you this, and hopefully this was insightful and you gleaned a little bit from it. And with that, if you got any more questions, and if this was not enough to get you at least started, or you're still a little bit unsure about some things, send any correspondence to innercircletrader@gmail.com. And as always, folks, good luck and good trading.